In this video, we will derive the expected return risk relationship of the capital asset pricing model. I will present a 5-step MBA-like derivation of the expected risk premium systematic risk relationship. Okay, we assume that all CAPM assumptions hold. If you want to refresh these assumptions, have a look at my previous video. Now, following these assumptions, it holds that first, the market portfolio is in fact the tangency portfolio. Second, the entire market risk sigma square m is therefore systematic and undiversifiable. Third, an asset A with variance sigma square A and portfolio weight WA contributes WA times the covariance of RA with RM to the risk of the market portfolio. Fourth, on the other hand, assets A contribution to the expected risk premium of the market portfolio is WA times the expected risk premium of asset A. So fifth, in equilibrium, all assets have to pay the same risk-adjusted risk premium. Hence, for asset A, it has to hold that WA times the expected risk premium of asset A divided by its systematic risk contribution, which is WA times the covariance RA with RM, that has to equal the risk-adjusted return of the market, which is the expected risk premium of the market divided by the variance of the market, which according to the CAPM also has to equal the aggregate risk aversion of the market. So hence, we've just derived the famous CAPM relationship between an asset's risk premium and the asset's amount of systematic risk. So let's re-express that mathematically. We've shown that the expected risk premium of an asset A coincides with the covariance of assets return A, RM over the variance of the market times the expected market risk premium. Now the covariance over the variance term is what we term beta A. So we see the often quoted CAPM relationship that the expected risk premium of asset A equals beta A times the expected risk premium of the market. And we can also rewrite that as saying that the expected risk premium of asset A is the risk aversion of the market times the risk contribution of asset A to the market, which is covariance RA, RM. So we can represent the linear expected return beta relationship graphically. On the x-axis, we plot the beta of an asset, while on the y-axis, we plot the expected return of that asset. An asset with a beta of 0 pays the risk-free rate. The market portfolio has a beta of 1. Assets with a positive beta pay an expected return that is above the risk-free rate. Assets with a negative beta pay an expected return that is below the risk-free rate. According to the CAPM, all mu beta combinations line up on a straight line. That line is called security market line, or in short SML. So assets on the SML are considered to be fairly priced. Their price equals the sum of all expected future cash flows discounted by the discount rate mu. And according to the CAPM, mu is determined according to the linear SML relation. Notice, an overvalued asset would have a discount rate mu that is below the security market line. Its discount rate is too low relative to the CAPM, and hence its price is too high, which means the asset is overvalued.